Turning a home into a digital asset traded on global markets is no longer science fiction. Proponents of tokenization, including the BIS, BlackRock and G20 governments now, envision a future where property is divided into fractional shares, represented as digital tokens on a distributed ledger. Each token can represent equity, future appreciation, or even rental income. In theory, this creates liquidity, broadens access to property investment, and allows homeowners to monetize wealth without selling outright. The technology is relatively simple, but the consequences are complex and very personal. This is the first video in a mini-series on tokenization and property. Later videos will explore implications for prospective buyers, mortgage holders, and full equity homeowners. All of the videos on tokenization are going to be in their own separate playlist, which I hope is useful. In addition, I'll provide a summary of this video on my Substack page, so the link should be below. Financial markets have a long history of repackaging real estate. The practice dates back to antiquity, but it was first legalized in the Roman Republic and later preserved through canon law to maintain continuity in the financialization of property. In 17th and 18th century Europe, landowners and merchant banks organized real estate syndicates where multiple investors would share ownership of large estates or urban rental properties. This allowed participants to benefit from property income without direct management. Urbanization and industrialization in the 19th century accelerated this trend. In cities like London, Paris, and New York, investors bought shares in housing cooperatives, tenant-managed blocks, and income-producing buildings. Early mortgage lending then appeared, with bonds backed by pooled property interests, allowing investors to trade claims on rental income, though less formalized than 20th century REITs or mortgage-backed securities. The principle was clear. Dividing and distributing property rights could unlock capital, increase liquidity, and if mismanaged, concentrate risks that harmed smaller investors rather than the larger ones. By the late 19th century, speculation in urban property and unstable pooling structures had destabilized markets, foreshadowing systemic vulnerabilities that would later erupt globally with mortgage-backed securities and, of course, the 2008 crisis. 20th century innovation simply scaled and digitized what had been attempted for centuries, that is, turning property into tradable claims on income and equity. Tokenization follows that similar trajectory, but with a twist. Rather than repackaging debt, it slices ownership of the home itself. Tokens can be traded instantly, creating layers of participation resembling collateralized debt obligations, or CDOs, that you may recognize the term from the 2008 crisis. Complexity and liquidity can obscure true exposure, leaving households and markets vulnerable to sudden swings and structural fragility. Now, with tokenization, it is possible that homeowners may lose full control when they tokenize a home. Renovations, repairs, or decisions about selling may require approval or input from multiple external investors. Conflicts could arise if investor priorities differ from the residents' needs. Homeowners may also face challenges if they wish to buy back tokens to regain full control. So understanding the governance structure of token ownership is critical before embracing tokenization. Tokenization can also influence daily living arrangements. Significant stakes held by external investors could create disputes over occupancy, access, or use of the home. Platform failures or conflicts with token holders could even threaten the homeowner's ability to remain in the property. Now, a point I keep making is that today the main barrier to home ownership is the state, navigating title registries, zoning, taxation, and legal recognition of ownership. But once cleared, ownership is largely direct and free from intermediaries. Tokenization multiplies the gatekeepers. The state continues to anchor legal recognition. Regulators apply securities laws, investor protections, and compliance rules. Platforms manage issuance, custody, trading, and governance. Then there's smart contracts and ledger rules, which dictate what owners and investors can and can't do. Now homeowners face overlapping authorities. So what was a direct relationship with a home becomes mediated by state power, regulatory frameworks, private platforms, and technical protocols, introducing potential points of failure and oversight. Tokenized housing is still new, but it's expected to grow for the following reasons. First, what we're already seeing is institutional adoption and endorsement by supranational organizations. Large investors and funds are experimenting with tokenized real estate. Early programs show that dividing property into digital shares makes it easier to trade and encourages participation. And there's regulatory and legal adaptation. Governments and regulators are beginning to recognize tokenized property as real ownership, making transactions safer and more accessible. Third, platform maturity and technical reliability. Blockchain platforms are improving in custody, governance, and transaction efficiency. So this helps to reduce technical and operational risks in theory. Fourth, market pressures and liquidity needs. Rising housing costs and limited capital create demand for alternative ways to unlock home purchases and equity, which gives homeowners the chance of accessing liquidity, and investors are offered new opportunities. Then there's the gradual penetration that we will see in later years. Adoption will likely start in high-value cities with strong regulatory and technical infrastructure. Fractional ownership may first appear in apartment buildings or rental portfolios before coming for single-family homes. Over time, tokenized housing is likely to become the standard way people buy and own homes. This system is likely to increase market participation theoretically, but it also makes home ownership more dependent on platforms, regulators, and technical systems. Homeowners may have to share decision-making with token holders or platforms. Ownership, transactions, and rental income can be closely monitored, creating layers of surveillance. Residents may face pressure to comply with outside priorities or automated rules, and disputes could affect access or use of the home, as I've already mentioned. While tokenization offers liquidity and investment opportunities, it does increase that surveillance and shifts control from the individual towards the gatekeepers. Tokenizing a home is not free. Legal fees, registration costs, platform charges, and ongoing reporting obligations are likely to add up. Platforms may charge fees for issuing and trading tokens or distributing rental income. Homeowners must weigh these costs against potential liquidity gains to avoid unexpected financial strain, as well as the other points that we've mentioned in relation to divorce of control. It would also seem that tokenization complicates inheritance and family planning. Homes are traditionally passed down whole, ensuring continuity of ownership. Fractionalized ownership may require heirs to inherit only portions or negotiate with external token holders. Reacquiring full control may demand significant capital or coordination, which is likely to strain family resources. It's also important to note that tokenization can change how homeowners perceive property. So a once illiquid asset now becomes tradable, and therefore attention may shift towards market performance. Communities could see weaker attachment to place, higher turnover, and less engagement as external investors influence property decisions. Platforms like Realty and Propi have demonstrated fractionalized property trading and digital recording of transactions. While feasible, these pilots are small scale and do not yet cover owner-occupied homes. Legal recognition remains incomplete and platforms are vulnerable to technical failures. cyber attacks, or potentially mismanagement, which could expose owners and investors to loss. So that just points to bear in mind. Tokenization does offer the potential for liquidity of illiquid wealth and the potential for diversification. Investors can access markets at lower thresholds and the homeowners may unlock equity. But ownership dilution, volatile markets and platform failures introduce financial and personal risk. Intergenerational wealth may fragment and complexity can obscure true exposure. Large investors or corporations can gain effective control across multiple properties without holding full deeds. They can pressure homeowners to sell fractions or comply with investor priorities, which could gradually transfer household wealth. It's also worth considering that tokenized markets may be speculative, allowing manipulation that harms families. The basic function of housing as shelter could be undermined if profit is prioritized over occupancy, which increases displacement risk. So in conclusion, tokenization changes homes into tradable assets and affects control, security and inheritance. It adds new layers of oversight and shifts power towards platforms, regulators and financial actors. While it can provide liquidity and investment opportunities, it also creates dependence on those key gatekeepers. Yet people are increasingly seeing the reality of the world around them and recognizing the illusions that once guided conventional systems. I think this awareness allows individuals to actually make decisions to take control of their choices, whether they actually want to pursue digital assets, take advantage of tokenization, or other means that we've discussed on the channel. Humanity has the ability to adapt and reclaim agency. Understanding the truth gives people power and the chance to reshape their own futures. Now, I do hope this has been an interesting video. Thanks so much for joining me. Do consider subscribing, and I look forward to seeing you next time. Bye-bye.